think the exciting thing for us is that the opportunities are really coming from assets we already own rather than requiring new acquisitions. And we've often talked about our portfolio having the capacity to deliver accretive value enhancement opportunities, particularly across certain aspects of the portfolio.
Hello, you're watching Proactive. I'm joined by Foresight Environmental Infrastructure Investment Manager, Charlie Wright. Charlie, very good to speak with you. FGEN has just raised its dividend for the 12th consecutive year. What does that track record say about the resilience of the underlying portfolio?
So the dividend track record and our latest increase is probably one of the clearest demonstrations of what FGEN is designed to do. So since IPO in 2014, we've increased the dividend every year and have maintained dividend cover throughout that period. And this year we delivered dividend cover of 1.25 times. And now we have that further increase in the FY27 dividend target to 8.04 pence per share. And we're guiding towards a similar level of div cover next year as well. And what underpins that is not a single asset or technology, but the diversification of the portfolio. So we generate revenues from wind, solar, anaerobic digestion, biomass, low carbon transport, and waste and other environmental infrastructure. And those revenues come from a mix of power, gas, certificates, and subsidies and non-energy income streams. So that reduces our reliance on any one market driver. And we've consistently grown cash receipts from the portfolio over the longer term. So whilst markets have experienced significant volatility over the last few years through higher interest rates and changing power prices and evolving regulation, the operational portfolio has continued to generate the strong cash flows that support that dividend.
NAV per share edged down slightly to 105.2 pence, partly due to power price forecast changes, Charlie. How do you explain that to shareholders, and what's your confidence level in the NAV going forward?
So the first thing I'd highlight is that NAV per share only tells part of the story. So NAV per share, as you say, reduced modestly from 106.5 pence to 105.2 pence during the year. But shareholders also received 7.96 pence of dividends. So when you look at those together, the portfolio delivered a positive NAV total return of 6.2% over the period. And in terms of the NAV movement itself, there were a number of factors at play. So power price assumptions were softer than previously forecast, which affected parts of the renewable generation portfolio. But at the same time, we continue to operate in an environment where we have other parts of the portfolio that can compensate for some of that underperformance that might come from power prices. For example, our AD portfolio had an excellent period. Our battery storage assets, which generate revenues from the intermittent nature of our renewable energy generation assets, also showed excellent performance during the period. And so that diversification across different technologies means that even if power prices are softer than originally forecast, other parts of the portfolio can help compensate for that. And in terms of confidence in the NAV, we remain very comfortable with the valuation. We value our portfolio on a disciplined discounted cash flow methodology, and we have that reviewed by an independent third party every year. So we're very confident in the valuation and the valuation methodology and the rigor that goes behind that. And more broadly, our focus remains on the operational drivers of value creation within the portfolio. And obviously, power prices introduces value risk, both the upside and downside, but it's the operational progress across other parts of the portfolio that help to support value as well.
Charlie, you mentioned that diversification. You have 39 assets across renewable generation, energy infrastructure, sustainable resource management. How does that diversification actually protect investors when markets get volatile?
Yes, it's a good question. So we think diversification is one of FGEN's defining strengths and one of the key reasons the portfolio has been able to perform resiliently through a variety of market environments. And I think this year past is a very good example of that. So we have delivered the positive NAV total return of 6.2%, as I say, and that is in really in a year that has been characterized by headwinds, particularly across core renewable assets, particularly wind and solar. And if you look across the peer group that have a narrower focus on say, just wind and or solar, those funds have shown fairly negative results throughout the year with some NAV erosion. However, we have delivered a positive NAV return, and we think that is testament to that diversification. We are not dependent on a single weather pattern, a single power price assumption, or a subsidy framework or customer market. We generate revenues across a range of different technologies, markets, and regulatory frameworks. And that means we are simply less exposed to singular risks, whether that be weather or a single market assumption.
You mentioned encouraging ramp-up progress across your growth assets and follow-on investments delivering mid-teens IRRs. Where are the most exciting opportunities within the existing portfolio right now?
Yes, that's right. And I think the exciting thing for us is that the opportunities are really coming from assets we already own rather than requiring new acquisitions. And we've often talked about our portfolio having the capacity to deliver accretive value enhancement opportunities, particularly across certain aspects of the portfolio. And over the past year, that has been our follow-on investments into CNG and in the AD portfolio. And particularly in the AD portfolio, these are assets that naturally present more opportunity for expansion and growth than, say, just a wind or solar asset. So within the AD portfolio, we have invested into some carbon capture projects, as well as continued investment into the pressure reduction system at the Vulcan AD portfolio. And those investments between them have delivered or forecast to deliver a return or IRRs in the mid-teens. And so that is a very effective use of capital and is testament to the organic growth that our portfolio can deliver. And in addition to the follow-on investment into those parts of the portfolio, our growth assets as well continue to make good progress. So at CNG Fuels, our clean transport platform, our focus has been on continued growth in biomethane volumes through its national refueling network. And that's supported by increasing adoption of biomethane by heavy goods vehicles fleets. And we just signed up a contract with M&S for an order of about 300 CNG trucks. So that's a really positive development. The Glasshouse phase one construction is now fully complete, and the facility is operational and has been ahead of budget, both on revenue and EBITDA targets this year. So that's good progress. And Rjukan, our land-based aquaculture facility in Norway, that is now fully operational, producing fish and in its ramp-up trajectory. So we're very pleased with the not just the income aspect that our portfolio is continuing to support, but also the capital growth potential within the portfolio as well.
Your share price continues to trade at a sizable discount to NAV. What's your strategy to close that gap, Charlie?
Yes, it's a good question, and it's obviously one that we think about a lot. And we're very encouraged to see the positive share price momentum over the last couple of months. I think as at the last couple of days, that discount has narrowed to around 20%, and I think it's now the narrowest discount among the peer groups. So that's really positive, and I think that's a reflection of the performance that we have been able to deliver over the last year or two, where some of the peer group have struggled given the concentrated focus on wind and solar. But as I say, our diversified portfolio is really helping us to deliver positive performance across different markets and sectors. Now, I think with the discount, there's obviously things in our control and things outside of our control. What is in our control is continued operational performance, continued ramp up of the growth assets, taking a very active approach to management across the portfolio when it comes to follow-on investment opportunities, and looking slightly longer term. We will be increasingly looking to capital recycling across the portfolio to enable us to extend the life of the fund and continue to provide that robust cash flow far out into the longer term. There are things that are outside of our control, such as interest rates, that are obviously going to have a big influence on the discount as well. But I think, focusing on what we can do, we're very pleased with the results this year. We can see good momentum in the share price and a narrowing of the discount, and we hope that that will continue from here.
Charlie, thank you very much for taking the time to speak with us today.
Thank you.
Charlie Wright, Investment Manager at Foresight Environmental Infrastructure.